Mr. Dalio begins by making the analogy that a decline in the market is similar to an illness in that it continues to recur over and over again. Everything occurs for a purpose, and if you comprehend that reason and the process behind it, you will be able to recognize the warning signs. With the help of these warning signs, you can determine whether or not individuals are capable of repaying their obligations and how the current scenario is likely to evolve. When your debt increases at a rate that you can't keep up with and you won't be able to pay it back, this may be a sign that you have an issue that needs to be addressed. When you have a problem with your debt and interest rates are near zero, it signifies that the central bank and Federal Reserve won't be able to help you, and you'll end up hitting zero. The most recent time that something like this occurred was between the years 1928 and 1929, as well as between 1930 and 1931. Something happened in both 2007 and 2009 that was the same. When people have so much debt that their interest rates go to zero and they are unable to make payments, this is known as a debt crisis. The central bank will then need to print money in order to purchase financial assets. This action was carried out by every single entity. Therefore, the fact that we were able to observe step by step how they handled the situation was beneficial to our ability to survive the crisis. We were able to observe the rapidity with which things were deteriorating, as well as the actions that were taken to halt this process, which was strikingly similar to those taken by the Federal Reserve in 1932 and 1933. Now, printing money causes an increase in the prices of financial assets, adds money to the economy, and has the impacts on the economy and markets that we have observed up to this point. Then, we'll be at the point in the cycle where we are now, and people who already have financial assets will gain more from these purchases than those people who don't have any financial assets. It widens the gap between the rich and the poor, which in turn leads to populism, which leads to a situation that is very similar to the one before. Therefore, the fact that we are able to see how that dynamic works from the perspective of a mechanical system helps us handle it effectively. Because the borrowed money is used to buy assets that will be able to pay back the debt as they expand and the prices of those assets go up. The beginning of the debt cycle is the ideal phase because it is at this point that the cycle begins. The next step is the bubble stage, which is when everyone believes that because those assets increased in value in the past, they will continue to increase in value in the future and that it is profitable to borrow money to invest in them even when they cannot pay back their cash flow. The peak of the cycle typically coincides with the occurrence of a bubble, following which the Federal Reserve or the central bank begins to tighten monetary policy in an effort to deflate the bubble. Looking at it this way, we're getting closer to the peak of that cycle, though I wouldn't call it peak just yet. I'd put us in the 7th inning. He names the period after a tightness and a subsequent downturn the depression phase. When interest rates drop to zero, a depression sets in. This is in part due to their ineffectiveness as a monetary policy tool. This explains why 2008 followed a similar pattern to that of 1930. That's what happened during the low points of the Depression. Mr. Dalio thinks it's pretty late in this long-term debt cycle. We are late in the business cycle with respect to long-term debt, but it does not guarantee that a recession is coming. Subsequently, we might expect a recession or a downturn as downturns and recessions are inevitable. Because interest rates are near zero in Europe and Japan and the effectiveness of monetary policy quantitative easing is largely behind us now that they have put the money in and those asset values have increased. We have a situation in which the central bank's abilities to reverse it are more constrained. The disparity in income and the resulting rise of populism are other problems. They laid out a plan for tightening interest rates, raising interest rates, and tightening at a rate, but they didn't stick to it. When interest rates reach zero, you are in a different type of debt crisis and are more likely to suffer from depression. This time period is very similar to that of 1935 to 1940. We had a debt crisis from 1929 to 1932, and interest rates were at zero. From 2007 to 2009, we experienced a debt crisis that reached zero. Then, in both of those cases, central banks can only do one thing: print money and buy financial assets. They print money by purchasing financial assets in both cases, which raises financial asset prices, adds liquidity, and contributes to a wider wealth gap. Those with financial assets benefit when those without financial assets benefit. As a result of the wealth gap and the economy failing to provide for a large segment of the population during both periods, populism emerged. When did populism become so popular? The populism issue would be important during that time period. Looking ahead, we predict that the next downturn, which will most likely occur in a couple of years, will be a different type of downturn, very similar to that one that occurred from 1937 to 1940. Now that we have reached this point in the cycle, the Federal Reserve and other central banks across the world are beginning, to varying degrees, to tighten monetary policy. Because the duration of those assets is stretched, asset prices are sensitive to changes in monetary policy. Central banks therefore need to exercise extreme caution in order to avoid raising interest rates far more quickly than is already factored into the curve. But the rise of populism has created a problem for us. When we consider how the next recession will play out, we realize that it will be substantially different from the one that occurred in 2008. There would be a significant increase in social and political issues. Interest rates and quantitative easing are both components of monetary policy. The acquisition of financial assets displaces other financial assets and brings into the system just those assets that are purchased. It will be difficult to meet all of these obligations, and Mr. Dalio believes that this will be more of a catastrophe with regard to the dollar than it will be with regard to the debt. When we have to sell a significant amount of government bonds, we could be facing a crisis that is more political, local, and social in nature. It is not possible for Americans to purchase all of those treasury bonds at once. If interest rates rise by an excessive amount, the typical result is a tightening of credit. As a result, less money is borrowed, which leads to a deterioration in the state of the economy. When they look at the interest rate, international investors aren't concerned about inflation since we'll be selling to people from other countries. Rather, they are concerned about the value of their currency going down. When the value of a currency declines, the price of bonds falls, and I believe that the Federal Reserve will have to print more money at that moment to make up for the deficit. They will also have to monetize more, which will cause the value of the dollar to decrease as a result of these two factors. During that span of time, there is a reasonable possibility that the value of the dollar will fall by 30%. Since the fiscal stimulation that we are experiencing is coinciding with a higher rate of capacity utilization, we are receiving that stimulation at a later stage in the business cycle than usual. That's a stimulant that will keep you feeling good for a while, but how you feel now does not predict what will happen in the future. The happiest feelings come from blowing bubbles since they are formed of euphoria. The arrival of the fiscal stimulus is cause for celebration, as it should be. Reduced corporation tax rates have a positive effect on levels of productivity. Companies that already have a large cash reserve are receiving a significant amount of investment capital. If you do this when that stimulus goes through and then begins to decrease, but the borrowing does not, then the borrowing will be available in the market around the time that occurs. The cycles consist of the cycles, the balance of payments, and the supply-demand ratio of credit. It is vitally crucial that you and every other individual thoroughly investigate how these cycles operate. Investors have the option of deciding whether or not they want to be active participants in the market at any given time. In general, people should not be actively seeking to invest, but if they do, then they need to operate in a way that is counter to their natural tendencies. Mr. Dalio is stressing the need of being able to maintain a sense of equilibrium in one's investment portfolio. Maintaining your desired asset allocation, in which different investments account for different percentage of your portfolio, such as 80% stocks and 20% bonds, requires a periodic rebalancing of your holdings. If you want to be able to retire at 65, for example, but still want to take reasonable risks, your target asset allocation is the proportion of your portfolio that you should have in each investment type.